Let's turn to the corporate bond market because, contrary to popular belief, recent reports from Bank of America and Jane Street Group saying that ETFs are boosting this space. We've been talking about this for a while. This makes some sense. So you look at thinly traded parts of the market like high yield, okay? Got a lot of people coming in, buying it, and that's going to help stabilize it, as opposed to people who say, oh, ETFs are going to cause some massive, destruction of the market, which we haven't seen yet. But just wait, they say, if there's stress in the market. Well, we have stress in the market. What was December? We were biting our nails off down here.
Yeah, I mean, I do think that, like I said, I think that fixed income ETFs have become the fixed income market. That's where we see a ton of the activity now. And they've given access to things like high yield or junk bond munis that were very difficult to get except in specialized, generally overpriced mutual funds. I mean, do you think that the corporate bond market's fundamentally different now than it was 10 years ago?
No, and frankly, given the increase in the size of the corporate bond market, corporate bonds are now 50% of GDP. They've never been that high before in history. You do need new sources of liquidity, new sources of demand to fund that.
Yeah, and remember something too. When you're dealing out there with these bond markets, when you get redemptions with bonds, you have to sell the bonds, obviously, right? But that's the same with here. It's not necessarily the case, though, necessarily with bond ETFs.
Well, a lot of bond ETFs will do creations and redemptions in cash instead of in kind. So there can be a difference there. But fundamentally, markets are markets, and if everybody wants to sell, prices are going to come down, and that will get transmitted into the underlying bonds.
Yeah. So is this less so for more liquid investments? I mean, it doesn't matter that it matters less, say, with investment-grade corporate bonds. I'm just trying to think of something that's really big.
Or treasuries.
Or something like that. It would matter a little bit less, right?
Yes, exactly. Those are already liquid markets with a lot of price discovery. But to your point, if you have a volatile bond market and it begins to hit ETFs, ETFs will just price to a discount to NAV rather than force the ETF to blow out the positions. Unlike a mutual fund where you get big mutual fund redemptions, the PM has to sell those positions.